Welcome to KBRA Podcasts, where we cover topical research discussions, industry commentary, and more. Stay tuned for insight from our knowledgeable team members.
Welcome to KBRA's third quarter 2022 Compendium podcast, where we will highlight key insights for the banking industry, but specifically KBRA's coverage universe. We are joined by Senior Director Leah Hallfors and Director John Rempe, both in the Financial Institutions Group. I'm Managing Director Brian Ropp, also in the financials team, and I will serve as moderator for today's discussion. So Leah, I will begin with a question to you on what stood out to you in the third quarter for bank earnings and then also credit profiles.
Well, Brian, the intensified tightening cycle remained unsurprisingly at the forefront of management team's commentary on third quarter earnings calls. And from an earnings perspective, this resulted in continued competing tailwinds and headwinds to banks' operating performance, which we really started to see last quarter. KBRA-rated banks remained resilient, however, with a median ROA of 1.24% in 3Q versus 1.15% last quarter and 1.28% a year ago. There were also a number of key themes that carried through most of our bank's performance metrics during the quarter, with long-awaited margin expansion accelerating as the impact of recent rate hikes continued to trickle down into banks' balance sheets. And KBRA-rated banks reported a medium NIM of 3.57%, which was up 22 basis points sequentially. As we noted last quarter, most banks entered 2022 in an asset-sensitive position and continued to report strong results in their spread lending businesses in the third quarter. Also, while funding cost increases were generally contained and remained low overall, we did begin to see some more pronounced deposit cost increases emerge for banks with potentially less durable deposit franchises, which could threaten margin expansion in future quarters in our view, though at this point have been largely offset by the increase in earning asset yields. Meanwhile, we saw banks generally book higher provision expenses, reflecting a combination of continued solid loan pipelines and also just a general tone of caution in view of the macro environment, with reserve releases less common in 2022. And then outside of spread-based income, most banks reported continued softness in fee income business lines, again due to the higher rate environment and capital markets volatility, while many banks are also subject to headwinds following the elimination or reduction of non-sufficient fund and overdraft fees. That said, there is a clear distinction between those institutions with less reliance on more volatile sources of fee income, such as mortgage banking and gain on sale. And then on the second part of your question, Brian, on the credit front, despite cautionary headwinds, asset quality indicators continued to trend favorably in the third quarter. We saw NPA ratios holding generally steady and loss content remaining minimal at this point overall. And many management teams communicated still solid consumer sentiment despite inflation and sharp rate hikes, as the impact has yet to meaningfully spread through borrowing bases. And to date, many customers have remained relatively insulated by the lingering benefits of pandemic relief programs. That said, we do recognize that there will be a lagged effect on loan portfolio quality and the emergence of potential loss content as the benefits of the pandemic relief programs and government stimulus wane over time. But for now, Brian, banks overall are still reporting healthy credit quality, with management teams largely expressing little to no deterioration within loan books, and they appear to be cautiously preparing for more normalized credit conditions through modest reserve building.
Well, thank you, Leah. I appreciate that insight. John, for you, I'm going to give you the second question. So did the additional 150 basis points of interest rate increases in the Fed funds in the third quarter impact loan growth during the quarter?
Yeah, that's a good question, Brian. And yes, the industry continued to report pretty robust loan growth during the third quarter, despite the Fed's restrictive monetary policies and the rises in interest rates so far. And more specific to our rated universe, the average loan growth for the quarter was 18% annualized, which is pretty eye-popping considering the market dynamics. And at least for the banks in my personal coverage, it sounds like loan growth was pretty broad-based, with strong growth across the board with regard to loan types and geographies. With that being said, most bank management teams stated that this rapid pace of loan growth is unlikely to continue moving forward, and that they expect moderating loan growth in the fourth quarter and into 2023. And altogether, while the recent loan growth has certainly been a positive for banks as they deployed excess liquidity that was sort of lingering from the pandemic into higher interest earning assets. We are staying mindful around loan portfolio concentration risks and underwriting standards. And it appears that, well, for the banks that report them at least, that underwriting standards remain pretty conservative with low LTVs and strong debt service coverage on new loan originations. Didn't mean to turn a loan growth question into a credit quality discussion, but I felt that was worth noting.
Thanks, John. I appreciate the insights. So, Leah, the next question to you. Deposit growth stalled out in the second quarter with the industry experiencing negative flows. So did this trend continue in the third quarter? Also, has the composition of deposits changed over the last 2 quarters in light of the deposit flows?
Yeah, so as a whole, the industry was able to contain deposit outflows reasonably well, with total deposits contracting by less than 1%. And what we've seen thus far is that banks are strategizing rate increases to stem the outflow of less sticky deposits. So for our rated universe, last quarter, we noted banks were generally willing to let non-core and certain higher cost deposits exit. But this quarter, following further rate hikes, we saw the median cost of deposits more than double, albeit it was still to a comparatively low and manageable medium of 37 basis points. And we also saw a 17% increase in non-core funding as banks look for the most cost-effective funding composition mix, while those with weak core deposit franchises exhibited some more pressure. Management teams again emphasize their focus on maintaining and growing core deposit compositions, which will become more challenging with the prospect of higher rates and increased competition. And this is a stark difference versus what we saw following the influx of liquidity into the banking system following the onset of the pandemic. That said, many banks are still benefiting from that excess liquidity to date and have yet to see the impact of these dynamics materialize in a significant way. Still, the durability of deposit franchises will continue to be tested in the coming quarters, which is where we believe we will start to see banks differentiate themselves.
Thanks, Leah. So, John, I'm going to give you the fourth question. So with the Fed raising interest rates by 300 basis points through the third quarter of this year, how has deposit betas performed for the industry? And then a follow-up question, how are core deposit funded banks performing versus more wholesale funded banks' deposit betas faring?
Yes, deposit betas and deposit costs, the hot topic, but definitely warranted. As Leah mentioned, deposit costs have remained pretty well contained. Most of the banks in our universe reporting a relatively low beta thus far throughout the Fed's rate hikes. And when you look at the effective Fed funds rate, which averaged around 220 for the third quarter, and the average cost of deposits for our rated banks of just 37 basis points, this puts the deposit beta around 17%, which is obviously pretty low so far. With that said, most bank management teams are forecasting for a higher beta in coming quarters as deposit costs catch up. And I think somewhere between a 25%, 40% beta for all-in deposit costs through this cycle is what a majority of our banks are expecting. So we should expect higher betas and certainly much higher deposit costs moving forward, especially with the recent 75 basis point increase in the Fed funds target rate that just occurred in November. And then for the second part of your question, Brian, regarding the deposit betas and how that relates to the level of core deposits, unsurprisingly, the banks with the highest cost of deposits for the third quarter were generally banks with a comparatively lower level of core deposits relative to total funding. But I think even more importantly, there's clearly a correlation between the banks with the highest cost of deposits and their loan to deposit ratios. The banks that reported the highest cost of deposits were generally banks with loan to deposit ratios nearing or exceeding 100%, as that next marginal deposit customer obviously becomes a lot more costly. And then on the flip side, banks with lower loan to deposit ratios and excess liquidity have had the luxury to pick and choose certain deposit relationships where they have the flexibility to allow certain price sensitive depositors to leave the bank if they want to go rate shop. These banks may have seen a little bit in deposit outflows, but their cost of deposits and NIM have certainly benefited. And just sticking on the topic of deposit balances, Leah did a great job of talking about the contraction our banks reported during the third quarter. And here's just another data point for you. Nearly half of all our rated banks reported deposit outflows for the quarter. And just my 2 cents here, I certainly think the prevalence of technology has played a huge role during this tightening cycle. And it seems that retail customers are more willing to move deposits and rate shop a bit I think this certainly has to do with the precipitous rise in interest rates. And it seems like people are more focused on what banks are paying this time around. And another interesting data point, when you look at the online banks, they reported pretty strong quarter-over-quarter deposit growth in the mid-single digits in the third quarter, while smaller regional and community banks are sort of fighting over deposits and seeing some outflows. So this kind of begs the question around liquidity management. With banks' securities portfolios being significantly impacted by negative AOCI, that's not really a feasible source of liquidity at this point, and you're seeing more securities being moved to HTM anyway. Of course, banks have borrowing capacity. They can repo securities or pledge assets to borrow from the FHLB or even tap the broker channels, but all those options are costly. So I say all that to say deposit balances, liquidity, and how that impacts funding costs is definitely something to watch moving forward.
Thanks, John. That's some great insight into deposit flows and cost of deposits for our banking universe. Leah, I'm going to give you the last question, which should tie all this together. So what is KBRA's outlook for the industry in 2023 if you consider inflationary pressures and overall higher interest rates?
Yeah, thanks, Brian. So we maintain our stable outlook for the U.S. banking industry for 2023. And as noted, our rated universe has remained resilient over time, and we believe are entering 2023 from a position of relative strength. We note that favorable NIM and net interest income trends seem likely to continue through the fourth quarter, though the outlook for bottom line returns remains more uncertain, with the prospect of continued rate increases and competing tailwinds and headwinds like we discussed earlier. We will also be watching how banks balance managing the rise in deposit costs and minimizing deposit betas, which again will present challenges in the coming quarters in our view, and could even reverse recent positive earnings developments for banks with weaker deposit franchises particularly. And we'll also be looking at how that dynamic may alter banks' funding compositions as well. Meanwhile, credit fundamentals have remained solid thus far, and while there is certainly a tone of caution heading into 2023, we recognize banks as better positioned to withstand stress conditions versus previous cycles, now having stronger capital profiles, generally reduced asset and liability concentration risk, and higher loss buffers in place, which altogether support our stable outlook for the industry.
Well, thanks, Leah and John, for helping us walk through the key observations and themes for the third quarter, which we discuss further in our third quarter 2022 U.S. Bank Compendium, available on our website. We want to thank our listeners for tuning in to KBRA's Bank podcast. For more in-depth information on the topics discussed today, as well as summaries on all our publicly traded U.S. banks in the KBRA-rated universe, please check out our compendium research piece at www.kbra.com, where you can find all of our research. We look forward to speaking with everyone again next quarter. Thanks.
This concludes our episode. Please continue the conversation on LinkedIn and Twitter at Kroll Bond Rating. We'd also like to remind you that all of our ratings and research reports are available at KBRA.com. Lastly, please share any feedback or ideas for future podcast episodes by emailing us at media@kbra.com. We hope to see you next time.